Hey traders, welcome to Charts and Coffee. Hope everyone is having a good Friday morning. It is OpX, which you know means shenanigans. We've already seen a lot of momentum this week, and a lot of that momentum has been to the downside. We're getting a pretty reasonable pullback considering the overall rally we've had this year. This is not April. This is not the kind of month where we're seeing movement because of shifts in expectation for rate cuts. This is not the kind of movement where a few Fed members are talking very hawkishly, things like that. And I think the most important thing to keep in mind is that the overall trend, despite the pullback, is still very much intact. So, sometimes we're going to have a reversion to the mean, which is exactly what we are getting. And instead of stopping at the daily price movement range, which I would say we've done easily about 80% of the time this year, we're definitely seeing a little bit more action that suggests that OpEx is not. By the way, I did a little breakout session, and hang on one second for me, gang. My toss is still warming up. It's been about 10 minutes. Weird. Okay. Anyways, I'm on TradingView right now, if you hadn't noticed. So when we take a look at the degree to which we pull back, and for those of you that are wondering, Rog, is this a shift in expectations? All right, so an internet outage has whacked a ton of stuff on the East Coast. Okay, well, there's that. So if I'm taking a look at the pullback here, let's talk about the pullback, comparing it to April, right? We're thinking, oh my gosh, is this going to be April again? The only way this turns into more of an April is if we break, as you can see we did back in here, if we break the mean reversion. Those mean reversion lines are the green, yellow, and red lines on my chart here. And I look at mean reversion for the overall trend on the daily time frame, not the 1 hour, not the weekly, the daily. And so far, we have, as you can see, sunk into this level. Now, if it was not OpX, I'd probably not care as much, right? I'd say, okay, let's grab the mean reversion. Let's get long some calls. But I'll tell you what, I got long calls at the end of Q2 as we went into Q3, and that was QQQXLK. And even that was kind of volatile. There was really no issue with the follow through. And OpX tends to be a singular session where the overall, well, think of it this way, where the overall attention is for today. I know it's kind of dark here in the office. Sorry, I didn't turn the lights on today. The attention is only for today. And when we get back to Monday, we kind of get back onto a normal path. But the question is, Rob, what's the normal path? What's the path of continuation? It's still up. So let me show you all something else here. This is the 5-day look at sector performance. So if you're wondering, hey, the index that I like to trade, whether it's Dow, Nas, S&P, Russell, the index that I like to trade, for example, why might it be struggling, or why might it be accelerating, or why might it be holding while other indices are pulling back? And this 5-day normalized performance, I know it's full of a lot of secret squiggle here, but here is why take a peek, why the Russell's been so strong. Take a look at the KRE on a 5-day normalized performance. Here's why the Dow has been strong, right? Those are right here. Look at that. Financials are the number one weighted sector in the Dow. Industrials, while not really a dominant sector in the Dow, there they are, right? Energy, that's also an important sector in the Dow. So these marginally help the S&P, but here's the problem with the S&P. Let's go down to the bottom of the list. XLC, XLK, SMH. So why is, and even XLY is right there, but why is the S&P so weak? Why is the NASDAQ so weak? Because these sectors that are most influential within them are just not having a very good end of the week. They were pretty stable up until about Wednesday. And you can see what's happened since Wednesday. And you can see what's happened since Wednesday on regional banks, energy, financials, and industrials. So when you think about why is my sector up or down, or why is my stock up or down, look at the index, but it works the other way around. When you're looking at why your index might be up or down, look at the pieces that are most influential on it. All right. So if you're kind of thinking, Rog, what the heck is happening? Go back to the data, right? Without data, we panic. When we panic, we don't make great decisions. When we panic, we can't go into watch list building. So going into next week, not that dissimilar from the video that I cut either last Friday or was it Tuesday? I can't remember, but the free video. So whether you're a member or not, check out the free video over at Simpler Trading. And I talked about Russell and Dow for these reasons, because you got to lift the hood up on the index, look at that motor and say, all right, why is this motor outperforming, say, the other ones? And there's your answer right there. So when we start to see these names that have been struggling, here's your SMH, here's your XLK. When we see those start to surge back up higher, we'll start to see participation in the ES and NQ again, still in an uptrend, but just having a tough couple of sessions. And then if the Dow, right, and the Russell are to continue, I'd keep an eye on really just two sectors: KRE, regional banks for the Russell, and XLF, the big banks for the Dow. I'm never going to project what's going to keep happening. I always want to measure what is happening, right? Please remember, trading has never involved looking into the future. Trading will never involve having to know what's going to happen a week from now, a day from now, even an hour from now. We just work probabilities. And so we go back to the trend. Intraday, you can see there's a lot of weakness, but end of day, which is a completely different trend, right? One is a 5-minute or a 1 hour or a single day or sessions, like a slice of psychology, while the other one is the accumulation of what has been going on in the Dow, what has been going on in the S&P or in the Russell. All right, so with a quick breakdown there, what have we got? All right, first question is, hey there, John. Question is CRWD. All right, CRWD. So the question is, I hope CRWD hasn't struck my computers. Yeah, maybe. What's the news on CRWD? Cybersecurity firm CrowdStrike saw shares plunge Friday in pre-market trading after an update led to a major outage. Impacting businesses globally. Well, here is my where is it? Here's my Thinkorswim, and it's been doing this for, how long has it been doing this now for? About 20 minutes, 15, 20 minutes now? Yeah. All right. Well, this is why we always have backups, right? We want to have at least one other charting platform that we can put our symbols on, and then we want redundancy on the brokerage side as well. So, all right. But yeah, John, to your point, I'd say watching these little toss icons spin around, not looking promising. All right. What is my take on Hyatt? I haven't been looking at that sector. I won't yet quite. It's not a symbol that, first of all, I would run most of my indicators on. The first thing I'll check when I look at something like Hyatt is, whether or not there's a lot of liquidity in the option chain. So that's the first thing I usually think about when I'm looking at something like Hyatt. But I really don't have a read on things like that at the moment. I would, for now, likely steer clear of it at the moment. Let's go at least look at the stock, right? Okay. What is it? H? There we go. See, look how many H's there are. So if you're on TradingView, make sure you let it know which H you want. All right. So take a peek. It's not really on my radar at the moment. It's not a stock that I typically trade because it's not a stock that's usually tethered to the broader averages. But you can see, just like the broader averages, it's been pulling back. One thing that is really interesting, though, if you want to take a look at H, is the point of control for the year sitting at about $1.50. So I'd keep an eye on that level there. Do I have a clear trend? It's a very volatile one right now. So I'd keep an eye on that volume level, because that's where the most attention, the most size is sitting this year in Hyatt. And then you can look at the last quarter, and you'll see the point of control is pretty much the same. All right. Semiconductors look weak. Yeah, we're seeing SMH pull back, SOXL pull back, whatever version of that semiconductor. I prefer the SMH. But as I was showing on the graph of the normalized performance, yes, it's having a rough week, which doesn't mean it has to keep going down, especially when you step back and look at SMH. Here we go. Especially when you look at SMH within the context of what has been an overall trend, but it's been wobbly, and it's not wobbly because of this week alone. It wobbled back starting on July 1. And it did not regain a trend until the 15th. So I would consider it generally bullish, but here's a really big thing that my top tier candles do for me. See these red candles right there? That's not just low price, right? That's bearish participation. So I'm going to leave SMH alone, and I'll see what it wants to do in terms of, first of all, just the candle color. I need these candles to go back to being yellow or green. And then at that point, I can open the door back on them. But here's the thing. Do I then want to go to individual holdings within the semiconductors that don't have the red candles? And that's not a bad idea. But you'll notice that while there are still some trends, take a peek at the way in which so many of these stocks are gapping down in red. The moment you see a red candle and you're thinking about a trade with overnight implications, so a swing trade, I would say leave it alone. If you're looking long, leave it alone, or just day trade it so you can have a very quick type approach to getting in, getting out that same session. And that way, it doesn't really matter what it does the next day. Every day is a fresh setup. Every day is a fresh blank page. And that might be a really good way to trade some of these transitions. Dash, look at all the red. So if you're bearish, Dash is a great place to be bearish. And take a peek, right? Two things I'll point out on Dash. One, we are below, right here, the point of control. And two, we have entered the bearish hemisphere because now we're trading below the equator, which are these white dots. There should be on all of our charts, intraday, end of day, end of week, there should be a level where there is a general acceptance that something is bullish or bearish. Not having a bullish session or a bearish session within a bullish or bearish territory, but where is it within that larger overall opinion? And I would have to say Dash is still sitting in the bearish part of this daily time frame. So I would be more apt to say short the rips, not buy the dips. And you can see if I respect the trend that was, even though it's neutral right now, you can see the gray color here, even though it's neutral right now, respecting the trend that was says, oh, wait a minute, before the neutral was down, right? So that's where I'd say I'd keep more of that bearish expectation with Dash. All right, Eddie? All right. Oh, Daniel, the brand of coffee I drink is no longer sold in my... Daniel, I'll tell you right now, and Sector Secrets Mastery members, you might be shocked. I am not drinking coffee right now. I haven't had my first cup of coffee today. I thought, hey, let me see if I can go without a cup of coffee in the morning. And so far I'm functioning. So far I'm okay. I will have to go grab something, maybe a tea, maybe a yerba mate today. I know. Yerba mate in charts just doesn't have the same ring though, does it? All right, next up, iPod Touch says, great call on gold. Cool. I did not trade it though, but if you took some points, some dollars out of it, that's awesome. That's awesome. In terms of gold, the only thing I ever say, I don't know that I put a call, but thank you for the credit, but I don't want to take it. All I'm going to say is please, 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 if you are playing momentum, it's always going to be a vulnerable position when we have, I think what we did yesterday was we talked about how the break on the 5th of July was that initial momentum surge. We have been moving in a Darvis zone from June 10 until that break on July 5. Now, the next level to tackle would have been up in here, but that's late. right? So I guess the difference is if you have two Darvis levels, right? Let's say you're looking at a larger range like this, which is what gold was doing. And then you have a smaller range forming. These are all automated levels like that. This break is meaningful. That break is worthy of focusing on the momentum. This is where my concern was we might get a little toppy. And that's it. It's by no means saying, hey, I know this was going to sell off and let's take a short here at the top. No, not in any way, but it's a whole lot more vulnerable up here. This was a great Momo because it's early, right? It's early. And I don't want to use the word early because early is a timing thing. It's the initial opportunity to take advantage of movement to the upside rather than the later opportunity. Yeah. So now I appreciate you bringing up gold. And that's how that works. So that's how that works. All right. Next up is, let's see here. John asks, the ES and the NQ. Let's jump on over to ES. Sold off yesterday into their daily price movement range and the 34 EMA wave. So we sold off past the DPMR. Let me make that really clear. And we're sinking into the mean reversion. Yes. Why no swings? We did take an SPY. No, we did take an SPY. But here's the other thing to remember. If we're seeing moves, and this is really important, if we're seeing moves, now take a look at when things were far calmer. It's a really easy gauge when we use the daily price movement ranges. Notice that through all this area, we were never exceeding the gold or the gray. This looks like olive here, or gray zone, right? We're holding really well. That means we're trading within the 68% expectation, the 68% probability of what price typically does. What's the normal range? Do you see how we're pushing? Here, this was fine. This candle right there. So we stayed within that range here and here. Okay, look at this. We broke outside the range. We broke outside the range. We did it a big way again. Once that happened, there's only one of two things to do. One, I still want to generally be a buyer, but I also know the volatility is beyond the 68%. Now we're in that rare air of 32%. And the confidence I have of holding is lower because we're in a more uncharacteristic state of momentum and market behavior. So if we can today stay within the daily price movement ranges, come next week, I'll have a whole lot more confidence that the levels that we want to hold are holding and that we can manage risk. And what I mean by that is higher volatility doesn't necessarily mean directionally that we may not follow through. But remember, a trade is the journey to the target, not the target alone. So while I do expect higher highs to come, we're going to see rate cuts at least between probably September or November into possibly March to April of next year. I don't want to be bearish, but I know that risk management in this uncharacteristic environment is not what I want to focus on. And yeah, we did have an SPY swing. All right. Let's see. While we're talking about coffee, what about BROS? All right. Nope, I'll pass. Red candle. Red candle. All right. All right, gang. So that's a wrap. As always, thanks so much for being here for Charts and Coffee. We're here every Monday through Friday, 9 to 9:20. On Sunday, I'll see you all for Top Tier Outlook at 6 p.m. Eastern. All right, gang. Be good to each other. I'll talk with you soon.